So actually, yeah, if you want to maybe just give a little bit of an overview of Bernstein and what you guys do.
Yeah, no, excuse me. Happy to, and obviously, I appreciate the invite too. Happy to share some perspective. Like we were just chatting about a moment ago, we're living in strange times. So, yeah, for those that aren't familiar with who we are, or what we do, I'm an advisor with Bernstein. We're a wealth management firm. We actually have a global footprint, and we're particularly unique in that we have scale. Again, we have a global footprint, but we're not a bank. We don't sell insurance. We don't trade our own capital. Our firm only does two things, and that's research, and then leveraging that research to produce better planning and wealth management outcomes for our clients. And I actually think as far as that construction goes, and that narrow focus on what we do, that's actually really relevant today, because that unique construction allows us to be, we're actually a money manager for our clients. We don't outsource that process. So we actually have a direct line of communication with the portfolio managers and the research analysts that are actually managing our clients' money. So it gives us really direct and unique intel into what's going on in the markets, which is of course incredibly relevant today. Because again, we're living in unique times. So look, I don't know, Dan, how you want to move forward. I can dive in and share some thoughts, or how we kind of want to handle this.
Yeah, maybe share a little bit more about the research capabilities of your team, because I think it's important for sure.
Yeah, happy to. So the research in our firm there's really kind of two channels to it. We've got folks spread all over the world that conduct research into how to think about the capital markets and economies and companies and trends. And we take a really unique we have a really unique process for how we go about doing that. Historically, we haven't hired quote unquote Wall Street analysts, right? If we want somebody to help us understand the food industry, we will hire somebody from the food industry, and they learn how to do the analytical work, but you can't teach experience. And when we conduct research, we take a really unique approach to it. I mean, we had a project a handful of years ago where we wanted to understand the growth of frontier economies, right? Think about economies in sub-Saharan Africa, Central America, South America. And we actually had, for 2 years, we had teams going around the world and knocking on people's doors, literally just to ask consumers in these countries, what are the products that they're buying? Because those frontier economies, those consumers are going to be the next wave of consumption all over the world as those economies get access to more and more technology. So we wanted to get essentially an early lead on how to understand, how to think about their purchasing behavior. So that's the research side that helps us again understand how we can help people invest client capital better. The other side of our research focus is very much around planning, and that's a team of about 40 people spread throughout the country in the U.S. A lot of them are former accountants, excuse me, actuaries, attorneys, and they really focus their time on helping people understand what does their money actually mean to them, whether it's understanding what retirement might look like, or if you're a business owner, what's how you exit from your company. If you work at a publicly traded company, how to think about stock compensation. If you have philanthropic goals or goals around how to help, how to transfer wealth to your kids and grandkids. We have a full team dedicated it's a resource dedicated purely to trying to answer those questions.
Perfect. Yeah, appreciate the background. I guess maybe with that, maybe you can share your viewpoint on the happenings as it relates to the economy and how you guys are advising clients through this.
Yeah, of course, happy to, and yeah, maybe happy to is not the right way to frame that, because of course we're coming from a challenging time, and I don't that might be the understatement of the century. What I thought I could do is I can share some thoughts on how we're thinking about things from maybe three standpoints. One, how are we thinking about the economy? And then how are we thinking about investing in the stock market? And then also how are we thinking about one of the other things you invest in, like bonds or alternatives to help mitigate risk. So just starting from starting with the economy, look, there's no beating around the bush. We are in a recession. And candidly, a handful of weeks ago, if you'd asked us that question, we wouldn't have made that call. I was on I was having a conversation with our senior U.S. economist, and again, this is 3 or 4 weeks ago, which I know in these days that feels like an eternity. But we weren't ready to make that call. But one of the things that he did point to with respect to recession was, look, if you start seeing mass closures of schools, that's an early indicator that we're probably heading there, because it implies that a lot of people have to stay home from work. It's kind of an early indicator that there may be more closures to come, which we're seeing that with bars and restaurants. So, look, our expectations is, again, a global recession. The U.S., we think GDP contracts to about the tune of about 1.5% this year. And we think it grows next year, about 3.5%. We, of course, think Europe contracts this year. We do think they grow next year as well, but probably only 2%. Largely that comes from the fact that they're going to be coming from a more challenging footprint. And even China, look, we actually think China's GDP, their economy does grow to the tune of about 4%. But look, in relative terms, that's a cataclysmic failure for their economy. So they've got challenging times as well.
I'll share a little bit. Aaron, can you anchor that statement a little bit more?
About China's economy?
Yeah.
Yeah, I mean, for a long time, China had been growing in double-digit teens as far as their economic growth goes, year after year. Now it has been coming down. So it was into single digits, and for a long time there was kind of this line in the sand around, I think it was 6%, and it was thought to be again a huge failure if they ever dipped below that. But again, we know with what's played out in China with respect to the coronavirus, that's hit their economy very hard, right? That's going to be reflected particularly in the first quarter. But again, we still do expect growth around 4%. But again, it comes back to the point on a relative basis. That's a huge shortcoming.
Perfect. Thanks.
Of course, yeah.
I want to have that perspective.
Yeah, and I'll share in a minute just some thoughts about what we think actually for the numbers that we're looking at right now, what inputs kind of go into getting there. But before I do that, I want to lay the groundwork for two critical risks that we're keeping an eye on right now that are really important as we move forward. First one is liquidity. And when I say liquidity, what we're talking about there is the financial system itself. What I will say is look, this current situation is very unique and obviously pretty dramatic in nature. But I will say it's not 2008. And the reason I say that is because 2008 was a liquidity crisis. We were literally looking at the risk of the entire financial system collapsing. And we don't see that yet. Right now, things could change. Again, it's a very fluid situation. But as it is right now, you have banks incredibly well capitalized to be able to deal with a situation like this. And the Fed has already taken incredibly aggressive steps to ensure liquidity throughout the financial system. They made their intention clear that they don't want a repeat of 2008 where we are running the risk of a collapse of the financial system. So liquidity risk is the number one thing that we're keeping an eye on, but again, we're not concerned about that as of now. The other risk, and this is kind of the bigger risk that still needs to be resolved, revolves around solvency. And that gets back to us, right? Small businesses and people, and whether or not people have money in their pocket, are able to spend it, are able to pay their bills. And if there's not some sort of a structure or system in place to resolve that issue, because we know it's going to be an issue with so many layoffs that we're going to see right now, that's a risk that's going to be a problem. So what that kind of gets us to the economic figures that I'd shared with you as far as where we expect a recession, but then growth, that's really predicated on three things happening. One is the financial system remaining stable, right? Which again, right now we think we're fine there. The second is fiscal policy, fiscal stimulus. And this gets to the heart of the solvency issue. We have to see fiscal stimulus that's very resounding to be able to combat the shortage of capital, or again, the solvency risk in the hands of consumers and small businesses to be able to support the economy coming out of this. And then the third piece is the public health policy itself, right? The crisis surrounding COVID-19. Obviously, that's the driver behind all the risk that we're seeing right now. And look, I'm not a doctor. I have just as many questions I think everybody has. we are seeing some templates for at least how to improve the situation or resolution, right? China, you've seen improvement. South Korea. I mean, it seems to be that the trend is one of two things really gets you there: either massive mitigation techniques like quarantine, that's what we saw in China, or some sort of mass testing coupled with then concentrated targeting to contain, kind of like South Korea. But again, it remains to be seen how how we actually get there. So look, what I would say about just on the economy, just to kind of put a button on that, is it's going to be challenging, right? We've got a bumpy road ahead of us. The silver lining that I'll put in there is we do expect growth. We do expect to get past this. Again, we expect positive GDP growth in 2021. But look, I also concede that, right, as of today, 2021 feels like an eternity from now.
100%. What questions do people have? Throw them in the chat. Throw them in the Q&A.
I can jump in and talk a bit about the market as well. Do you want?
Let's transition into the market for now. We'll see if any questions come up.
Okay. Yeah. So look, so I'll talk about stocks first. So with respect to stocks, I mean, obviously it's been an incredibly unpleasant place to be. Look, what I would say is that your number one driver, obviously we know COVID-19, but the underpinning to that is uncertainty, right? The markets hate uncertainty. Again, it's not clear how this issue around COVID-19 resolves itself. And that uncertainty drives volatility in the marketplace, period. Obviously, we know certain industries are going to get hit much harder than others: airlines, hotels, restaurants, right? Travel, leisure. We know that there's a lot of damage in that space. And the things that we're doing is of course, assessing how company revenues are going to be impacted as a result of this. But B, also looking at it from an opportunistic standpoint. And, what I mean by that is that you are seeing companies are going to be hurt by this, but you are seeing indiscriminate selling, right? The proverbial baby with the bathwater idea. Everything's being sold. And if you can look at companies and look for companies that have bulletproof balance sheets, relatively low debt, positive free cash flow, and if they have enduring business models, there's opportunities there. I can tell you that just as an example, like the semiconductor space is something that we're really intrigued by. It's been a hot space, and frankly, the stocks across that space, that sector, have been really expensive. Now they're suddenly not that expensive, and a lot of them are going to benefit from long-term trends like the proliferation of electric vehicles, autonomous driving, which we do still think that cyclical trend continues despite lower oil prices. I'm happy that I can talk about oil prices. And then you've seen some sectors that are typically we might think it was more stable in nature, like utilities have been pummeled. There's some opportunities there. Pharmaceutical companies, look, irrespective of what's going on, we're still going to need to take our medicines. Logistics companies, supply chain, for example. Look, supply chains always mattered, but probably matters more than ever now. So logistics companies that work in the supply chain space are, of course, going to matter. And look, I'm not an analyst. I can't dig into specific stocks, but I can just tell you from a trend standpoint the things that we're really looking at. And then the things to be careful of are highly levered companies. If this issue drags on for a while, and a company is very highly levered, that's a problem, right? Because they may not be able to survive through this. And this gets back to my point about companies with bulletproof balance sheets.
Yeah, we're talking about highly levered, just so everyone's got the terminology down. If you could go back and touch on oil prices, I think it dropped down at one point yesterday to $20 a barrel. Maybe if that's always a topic that's in the news, whether it's relevant or not. So maybe get some perspective, if you would, on oil prices, and then we have a question about gold and specifically GDX and how it's dropped. So your perspective on that.
Okay. All right. Yeah. So on the oil prices, Look, oil dropping is, well, good and bad, right? On the good side, right, and we've seen this before in past challenging times in the economy when oil's dropped. It's suddenly energy costs get cheaper. Filling up the gas tank gets cheaper, and that's a good thing. That's a good thing for consumers. And I will tell you that the net benefit of oil going down is positive from oil dipping. But here's the problem, and here's why it's not necessarily a good thing today. It takes a while for that net benefit to filter through and really be felt by consumers. And we're not dealing with problems that are 6 months from now. We're dealing with issues that are today, in 2 weeks, and 4 weeks, and 8 weeks. And one of the things that we've seen, in our economy is the energy space and the oil space has grown a lot. It's a piece of our economy. Granted, it's not a huge piece, but there's a lot of people employed that work in that world. And the oil dipping in price is going to hurt that piece of the economy short term. So that's a problem, right? Because again, we're looking at short-term headwinds. So look, again, it's going back in some ways to this fiscal stimulus, because if we have the right fiscal stimulus to get us through this, then yes, we will feel a positive benefit from oil prices coming down. But it does create some short-term headwinds with respect to getting that energy complex in our economy.
Great.
And then there's a question you said?
Yeah, I don't know if you see it on your side, but Ted asks, what is your thoughts on why gold miners' GDX has dramatically collapsed? Gold is viewed as a hedge.
Yeah, to be honest, that's a good question, and I'm not sure of the exact answer. You're right. Typically, gold is seen as this safe haven. And I mean, look, I can speculate, and also, by the way, I can get an answer. I can follow up again. Goes back to what I was saying earlier about having a direct line to the folks that can really weigh in on this stuff. I'm happy to get an answer. It may have something to do with, I don't know if everybody saw that, when the Treasury, the 10-year Treasury in the U.S. dropped to just over 0.3% at one point, and then it moved back up to now it's over 1%, despite how much volatility we've still seen. So it might get back to a lot of people that were looking at gold and were invested in gold, actually essentially cycled out of it into Treasuries because they saw that the Treasury, with the rate coming up, could still be viewed as a better safe haven in the grand scheme of the world. So that's me just speculating, but I'm happy. I'll make a note. I'm happy to get an answer, and then you can circulate that back.
Yeah, maybe speak a little bit more just for clarification for everyone here about the Treasury rate and why that would be viewed as more of a safe haven and the typical viewpoint in terms of risk-free capital.
Yeah, happy to. So, historically, if you look at debt issued by the U.S. government, 10-year Treasury, it's viewed as risk-free capital, right? Risk-free rate. U.S. is always going to pay you back, and it still is. And one of the things that's been interesting over the years is, interest rates have been incredibly low. You buy a U.S. Treasury, a 10-year Treasury, you don't get a lot of money back. I mean, at the start of this year, the 10-year Treasury yield was 1.9%. Yet we still saw a lot of people buying 10-year Treasuries. And the question always was, well, why is that? And a lot of it was global demand, because if you look around the world, even though the interest rates here were low, it was still the best show in town, right? I mean, German bonds, the debt issued by the German government was literally negative. You paid them for the right to keep your money. So rates in the U.S. have been kept very low because you did have a lot of foreign demand for them. And look, in light of the current crisis, you saw a massive flight to safety when the market started crashing, and that really pressed the yield down, because essentially what happens is with debt instruments like the U.S. Treasury, when there's a lot of buyers, right, a lot of demand pushes the price up, that in turn brings the yield down. So we saw the yield on 10-year Treasury again drop to, I think it was just above 0.3%, if I remember right. But since then it's kind of stabilized and moved back up a little bit over 1%. And candidly, I'm not clear exactly on all the dynamics that pushed it back up a bit. But again, I speculate about this gold question that perhaps people that use gold as a safe haven may have cycled back into the Treasury because the yields creeped up and they saw it as being a safer place to be. But again, I'm happy to relay that question to some of my folks from our investment committee to see what they think.
Yeah, and maybe for everyone's benefit as well, if you could just explain yield very quickly relative to just, I think folks think in terms of interest rate, but there's a difference.
Yeah. So yield is essentially what's the actual percentage return you're going to get in the form of income based on an investment you make into a particular position. So, like I said, the 10-year Treasury had this yield of 1.9%. So if you invested in it if you invested in the 10-year Treasury, you were going to get 1.9% in terms of income each year, so long as you held that. When the markets got incredibly volatile and you saw the price, all this demand that pushed up the price, right? Well, now you're paying more for that Treasury bill. So if the yield was still 1.9%, right? Well, let's say that Treasury costs $100. At $100, the yield was 1%. If demand pushed the price up for that Treasury bill up to $110, right? Now suddenly you're paying $110. It still pays 1.9%, but that's at 100. So now your yield's dropping. So what happened was Treasury prices got pushed up dramatically, drove yields down.
Thank you. Appreciate that. I think you had one more bucket. Ted says thank you for looking into this. So yeah, appreciate it if you wouldn't mind.
Yep, happy to. I'm writing down that. So the last piece is, right, we talked about the economy, talked about stocks, and then the question is, all right, how do you protect yourself? Right? How do you give yourself, even if you're thinking opportunistically in stocks and things like that, how do you protect yourself? Because I don't want to imply this thing resolves itself tomorrow or next week or anything. So what are the things that you own to try to give yourself some element of ballast throughout these choppy times? And look, the first defense should always be some sort of fixed income or bond investments, right? Bonds tend to behave essentially, in some element inverse to stocks. They're protective in nature. And the key, by the way, is really holding high credit quality bonds. We've seen, particularly over the last couple of years, I talk about interest rates being really low. We've seen a lot of investors try to buy high yielding bonds as a way to get more income because they saw just returns on bonds were very low. The problem with high yielding bonds is that when the market experiences periods of stress like we're seeing right now, high yield bonds trade like stocks. They get crushed in price. So the key with bonds, when they're in your portfolio, to be some form of ballast, you want high credit quality and intermediate duration bonds are the things that we look at. And then I would also argue that, look, you in the bond world, you want to be able to be an active manager. You don't just want to own an index of bonds. And the reason I say that is that the bond market's relatively inefficient relative to stocks. And you want to be able to assess things like credit risk. That question's been coming up lately. Folks are asking, think about municipal bonds. They're saying, hey, if we go into a recession, is the city, state, or local government are they going to be able to pay their bills to pay those bonds? And look, we think the answer is as long as you do your research, absolutely yes. We're not worried about it. This question came up a lot in 2008, but you have to be able to do the research to make sure you're owning the right stuff, the right high quality paper. The other thing too is you can be really opportunistic, right? Again, with yields as low as they are, returns on bonds are going to be low. So the question is, how do you squeeze incremental yield out of that space? And there are opportunities to do so. We just saw last week with a lot of the panic selling, there was actually, you saw that actually hit bonds a little bit. There was panic selling in some bonds. People either needed cash or a lot of fund managers had to rebalance their portfolio. So they had to sell some bonds to rebuy stocks because their stock bond tilts got out of whack. And they were basically forced sellers. And what this did was it actually made the market wildly inefficient. And they were literally taking 10% haircuts on bond prices when they were selling, right? So we didn't rebalance because we said there's no sense. It's the amount of risk reduction that you get by rebalancing isn't worth it relative to the haircut you're going to take when you sell. And on top of that, we were opportunistic. We were actually looking for good bonds that we wanted to buy because we were buying them at effectively a 10% discount. So there's opportunities to add value in that space, but again, you have to be active. And the last kind of side piece I'd also add to this idea of how do you protect yourself, bonds being that first piece. The other piece is really alternative assets as well. looking at things that aren't stocks and aren't bonds, things like middle market debt, private equity, private real estate. There's a litany of things I can talk about, but the point is that you want, if we're in a world where, frankly, we do expect for the next 10 years, we think returns will be positive in stocks and bonds, but we think returns are going to be lower than historical norms. You want to own things that can behave unlike stocks, unlike bonds, and if you build it right, you can augment return and really even reduce risk.
I'm glad you added in that last piece, because I know in some of our text exchanges recently, we were talking about how your clients' portfolios were augmented with alternative investments, and really this perspective on stock and bond performance over the next 10 years, that's really unchanged. I mean, that was your guys' position for the last 2 years, really, maybe longer if I'm.
Yeah. I mean, look, we expected low returns. Last year was obviously a huge year, but we wouldn't have expected that. But you look where interest rates are at, where the economic cycle has been at, and granted, given this sell-off, I would imagine our expectations for stock returns will go up a little bit, but not a ton. And bond returns are still going to be a really important part of a portfolio to protect against risk. But bond returns are not going to be high going forward. I mean, if you just look at where interest rates are starting us at, it's just not possible. So returns, we think they're going to be positive, but we do think they're going to be lower than historical norms.
I know we're up at with just a couple minutes to go. So folks who have questions, I don't know how much longer you can stay after the 11:30 marker, but if people have questions, drop them in. I think the only thing making a little bit of a pivot back to somewhat principles, and there's one that we share in a lot in terms of thinking about risk, is this whole idea of core capital. And I've gotten a lot of questions from folks around essentially like trying to time the market and find this entry point and allocate some of their, say, cash that they have on hand back into the market. And I've expressed some concerns about trying to be overly opportunistic and taking on additional risk when you haven't locked in your core capital. So I'd love to get, if you could, sort of summarize in your guys' words, core capital and the way that ultimately you guys shape a lot of your viewpoints, because I think that's one of the building blocks.
Yeah, no, I'm glad you bring that up, because look, the most important thing that everybody should understand is that idea of core capital, right? What's the pool of money that will endow your lifestyle for the rest of your life, and doing so under the assumption of, what if the markets are challenging, inflation runs high, and you live a long time, right? Because, I mean, even take this current environment, we've done this planning for a lot of our clients to help understand what their core capital is. And while this isn't an enjoyable experience, they're okay, because we built that plan under this idea of what their core capital needs are. And core capital is a function of how much are you going to be needing to spend, what your age is, and what your allocation is. And when we think about allocation, the single most important thing with any investment portfolio construction is getting the allocation right. And that means, what's the right balance between things like stocks, bonds, and alternatives, such that you can achieve the desired amount of growth, while also mitigating the right amount of risk. Because the last thing we ever want to have happen is, in an environment like we're seeing right now, basically succumb to our emotions and start making the wrong decisions at the wrong time. Now, that doesn't mean, I think this gets confused sometimes when we think about an environment like this, and this idea of stay the course. Look, staying the course doesn't mean you stick your head in the sand and just wait till it's over, right? There's still ways to be opportunistic, like I was talking about earlier, within a portfolio, looking at different sectors where there's opportunity, being active in the bonds, maybe adding alternatives where it makes sense. But we don't want to get too far over our skis with this idea of again trying to time the market, pick the bottom. And speaking of that idea, pick the bottom, I think this is an important point, because some people, maybe they have cash and they're thinking about, I want to deploy it. depending on the time frame, I think there could be merit to that. And the way I think you really should think about it is this: is that never go into a decision like that thinking you're picking the bottom, right? But the one thing I can guarantee is, look, stocks are 30% cheaper than they were a month and a half ago, a month ago. And if somebody wants to invest capital opportunistically, think about that long-term allocation that's right for them, and then put it into the market in tranches, right? And then that way you're not running the risk of putting it all in, and then there is another 10 or 20% fallout, because then you're kicking yourself. But you break it into 3 pieces, put a piece in this month, a piece next month, a piece the month after. Now you've kind of spread out your risk of you don't have to worry about trying to get the timing right, because nobody can.
Yeah, it comes back to a couple of core principles that we teach, which is this idea that the most conservative thing to do is what you know today. Don't try to make assumptions or speculate. So in other words, there's no way of knowing if we're at the bottom. You're just speculating that's the case, right? So and then the other thing is, we're always trying to hedge downside risk. So because we cannot say definitively that we're at the bottom, the argument to piecemeal or tranche your way into it is that we're trying to hedge downside risk. So the downside risk is we're not entering at the bottom. And so one of the ways we can hedge that is by piecing our funds into the market in a way that, if in fact we weren't at the bottom, we don't totally lose our shorts on all of our capital that we can deploy. So just want to bring that back to some of the principles we talk about. And I think the whole concept of core capital as it relates to your personal finances, really the same exists within your business, which is there's a certain amount of core capital that you need to have on hand to be able to endow the future of your business. And that's why these reserve accounts that we talk about are so important. And having an algorithm, you didn't really speak to the algorithm that you guys use, but one of the reasons why your guys' clients are in such a good position right now is that you ran 10,000 market scenarios in determining their core capital based off their specific priorities, needs, et cetera, right? So the simulation is calculating or accounting for potential black swan type scenarios like this, right? I'm not misspeaking in that. So all that to say, Aaron, really appreciate you coming on. Fair to say, if people have questions, I can send them your way.
Yes, yeah, absolutely. Happy to share, and I'll send you a link that you can feel free to share with everybody that was on today. We just yesterday we had a call with our senior U.S. economist, head of our investment strategies, one of the co-heads of our U.S. portfolios, co-head of one of our fixed income strategies, and they were just talking about everything that's going on right now. So I'll send that to you, and feel free to share it. It's pretty interesting. And then, of course, if people have questions, I'm happy to be helpful.
Awesome. Yeah, if you guys want access to the video, let me know. Aaron, sorry I couldn't make it to that yesterday, but thanks for sharing it. And yeah, we'll see you all tomorrow. Thanks, Aaron. Appreciate it.
Of course. Thank you.
Awesome. Aaron, thank you.
Of course. Thanks, guys. Take care.